The illusion of high yield. We will tell you where you can find a 10% yield backed, at least indirectly, by US Treasuries. More importantly, we will tell you why you should probably avoid it. Retired investors naturally gravitate toward income. A long-dated Treasury bond may yield around 5%, but for someone relying on investment income to meet living expenses, that may not seem sufficient. Then along comes a Treasury fund advertising a 10% yield. Tempting, isn't it? Welcome to the world of yield illusions. Wall Street is more than willing to indulge investors' appetite for outsized payouts, and in the process, collect generous fees for doing so. Before we proceed, however, a brief detour. Yield shenanigans. These funds advertise generous distributions that are, in one way or another, difficult or impossible to sustain indefinitely. Ticker Fund Expense 1, Income 2. The problem. YI Amplify SEF High Income 3, 23%, 12%, 2 layers of fees can steadily erode your returns. CLM Cornerstone Strategic Investment 1, 10%, 20%. The strategy depends heavily on finding new investors willing to pay inflated prices. TLTW issues TLT Income Plus 30, 35%, 10%, a 5% Treasury yield cannot be magically transformed into a sustainable 10%. BTCI Neo's Bitcoin High Income 0, 99%, 26%. Bitcoin itself generates no income. JGH Nuveen Global High Income 1, 33%, 10%. Junk bonds can generate distributions while steadily eroding principal. SBAR Simplify Barrier Income 0, 75%, 12%. You are effectively selling crash insurance to other investors. TSLA Yield Max TSLA Option Income Strategy 1, 0, 7%, 55%. You may be sacrificing long-term capital for immediate distributions. Note: 1. Annual expenses as a percentage of net assets. 2. Distribution rate, which should not automatically be mistaken for economic income. 3. A BlackRock product that was, until September 17, officially known as the issuer's 20-plus-year Treasury Bond Buyrate Strategy Fund. Now back to the central point. The true yield of an investment is the amount it can distribute indefinitely without impairing its capital base. Think of it as the fruit produced by a tree, rather than the tree itself. The fruit is limited. You cannot simply declare that there is more of it. If you consistently spend more than the investment can genuinely generate, you are consuming capital. The evidence that many investors fail to appreciate this distinction is everywhere. The proliferation of funds with income in their names and eye-catching double-digit distribution rates. Examine many of these products closely and you will discover that, by one mechanism or another, they are effectively returning investors' own capital to them. What follows is a representative sample of funds with inflated or misleading payouts. For each, we will examine the mechanics behind the distribution and suggest a more straightforward alternative. We will also consider several stocks and preferred securities whose apparently extraordinary dividend yields may prove similarly difficult to sustain. 1. Issuers TLT Premium Income Plus. This exchange-traded fund holds a portfolio of Treasury securities and writes call options against them. The premiums collected from those options are distributed to shareholders alongside the bond's coupon payments in monthly cash distributions. Over the past year, according to Morningstar, those payouts have amounted to roughly 10% of the fund's share price, about twice the yield generated by the underlying bonds. Option premiums are, in a technical sense, a form of income, but it is a mistake to assume that such income is equivalent to a bond coupon that can be spent safely and indefinitely. Bond prices fluctuate. When they decline, an investor who has written call options against the bonds still suffers the decline. When bond prices subsequently recover, however, the upside may be surrendered because the options can be exercised and the bonds called away. There are favorable periods for writing
covered calls and unfavorable ones. Over time, however, a permanently committed covered call strategy is likely to sacrifice part of the portfolio's upside in exchange for immediate cash premiums. The economic cost of those premiums does not simply disappear. Several other bond ETFs have adopted similar premium income strategies. In many respects, the industry is repeating an old story. 4 decades ago, Treasury funds proliferated that enhanced their reported yields by selling options. The Securities and Exchange Commission eventually required managers to disclose a yield figure that excluded option income. The practice fell out of favor for years. Now it appears to be returning, aided by investors' short memories and their tendency to focus on headline distributions rather than the economic substance beneath them. Recommended alternative: a straightforward long-term Treasury fund, such as the Vanguard Long-Term Treasury Index ETF. Its yield may be lower, but it does not depend on financial engineering to create the appearance of additional income. 2. Simplify barrier income. This $25 ETF pays a fixed monthly distribution of 25 cents per share, equivalent to an annual payout of approximately 12%. On the surface, it is highly attractive. Where does the money come from? Primarily from selling options. In effect, the fund sells stock market crash insurance to other investors. If the market remains stable, the fund retains the premiums. If the market suffers a severe decline, however, a substantial portion of the fund's capital may be required to compensate the buyers of that protection. The structure is complex. The portfolio combines cash with a ladder of short put options, each with roughly 1 year to maturity. Each option is linked to the worst performing of 3 equity market benchmarks: large cap, small cap and growth stocks. If the worst performing index falls by more than 30%, the fund can absorb the full loss associated with the option. If the decline is smaller, or if markets rise, the fund owes nothing to the option buyer. There is also an early termination feature under which the option may expire prematurely, allowing the fund to retain the entire premium if markets follow a specified upward pattern. The result is a portfolio with meaningful equity market risk, though less than a conventional stock index fund. Its overall risk profile may be closer to that of a balanced portfolio combining stocks and bonds. Since its launch a little over a year ago, the fund has enjoyed unusually favorable conditions. It has attracted roughly $400 million in investor capital without experiencing the kind of market crash that would expose the strategy's full downside. Assume, for the sake of argument, that the fund receives fair compensation for the options it sells. Even then, the crucial question remains: what portion of that 12% distribution is genuine economic income? Consider an analogy. Suppose you help underwrite insurance on an offshore oil platform. Your share of the annual premium is $30,000, but once every 50 years a hurricane causes a $1 million loss. After many calm years, have you earned $30,000 annually? Not really. Your expected economic income is closer to the premium received minus the expected cost of the eventual catastrophe. In this example, that would be roughly $10,000 per year. The fund may be transparent about its risks, but investors should be equally clear-eyed about what the monthly distribution represents. A cash payout is not automatically synonymous with sustainable income. Recommended alternative: a broad, low-cost balanced index fund. If you require additional cash, sell a small number of shares rather than relying on a complex product to manufacture an artificially steady distribution. 3. NEOS Bitcoin High Income. The idea of turning cryptocurrency into a reliable income-producing retirement asset is, at best, an exercise in financial alchemy. Bitcoin does not produce income. This fund, like numerous similar products, uses covered call strategies to manufacture cash distributions. If Bitcoin eventually rebounds strongly from a bear market, the strategy may face the familiar problem confronting all call writers: Substantial upside can be surrendered in exchange for premiums received today. The result is not the creation of a new source of economic yield. It is the conversion of some potential future appreciation into current cash flow. Recommended alternative. If you need income, own high-quality bonds. If you want exposure to Bitcoin as a speculative asset, consider a low-cost Bitcoin fund rather than paying a premium for an income strategy built on top of an asset that generates no intrinsic yield. 4. Nuveen Global High Income. This leveraged closed-end fund invests in the debt of both financially vulnerable corporations and higher-risk sovereign borrowers. Its portfolio includes borrowers such as Goodyear Tire and countries such as Argentina. By historical standards, the fund has been well managed. Since its launch in 2014, it has outperformed a broad Vanguard junk bond fund. So why include it in a discussion about yield inflation? Because high reported yields can obscure the gradual erosion of principal. The fund distributes cash at a rate that annualizes to approximately 9.1% of net asset value, yet its long-term annual return has been closer to 5.2%. In other words, the portfolio is distributing more than it has historically been able to generate on a sustainable basis. This problem is not unique to one fund. High-yield bond portfolios can experience a gradual deterioration in principal because their best-performing bonds are often called away early. Bonds issued by companies whose financial prospects improve, or whose value rises because market interest rates fall, are redeemed. What remains can become increasingly concentrated in weaker credits. Since 2014, the fund's net asset value per share has declined from roughly $20 to $13.58. Investors should therefore resist the temptation to treat the stated yield of a junk bond fund as entirely spendable income. A more realistic calculation may require deducting several percentage points for expected principal erosion, followed by another adjustment for inflation. What remains is the sustainable yield. For an investor seeking to preserve purchasing power over time, withdrawing the full headline yield from a junk bond portfolio may be imprudent. A much lower withdrawal rate may be necessary. Recommended alternative. Treasury inflation-protected securities. A long-dated TIPS with a real yield of around 3% offers something far more valuable than a headline distribution. A return that is explicitly measured after inflation. 5. Yield Max TSLA Option Income Strategy. This fund, and many others like it, is designed for investors who want the excitement and growth potential of high volatility, low-yielding stocks while also demanding substantial current cash distributions. It attempts to satisfy both desires through a sophisticated option strategy involving call spreads. The difficulty is that the strategy can consume capital. According to Morningstar, the Yield Max Tesla fund distributed approximately $34 per share in dividends last year while its share price fell from roughly $71 to $38. More than 1/4 of the manufactured payout was also taxed as ordinary income at relatively high rates. A spectacular distribution yield can therefore coexist with a deeply disappointing investment outcome. Recommended alternative. If you want exposure to Tesla but also require income, consider a simpler allocation. Invest part of the money in Tesla shares and place the remainder in Treasury bills. The result may be less exciting, but the economics are far easier to understand. 6. Amplify CEF High Income. This fund of funds invests in shares of other investment companies, with a preference for closed-end funds trading below their net asset values. The portfolio blends equity and fixed income closed-end funds. Some of those underlying holdings generate attractive dividends, which Amplify passes through to shareholders. Yet the incoming cash appears insufficient to support the fund's generous distributions. More than half of the fund's payout last year was classified as a return of capital, meaning that investors were, to a significant extent, receiving their own money back. You do not need to pay a fund manager a substantial fee to return your own capital. You can accomplish that yourself by selling a few shares. Then there are the expenses. Amplify reports a total expense ratio, including costs charged by the underlying funds, of 3.23%. Depending on how certain costs are classified, the economic burden may be substantial even if some of those expenses are excluded from conventional management fee comparisons. Either way, the cost structure is difficult to justify. Recommended alternative: if you are attracted to the concept of buying investment assets at a discount to their underlying value, consider a low-cost diversified closed-end fund with a meaningful discount and a substantially lower expense ratio. 7. Cornerstone strategic investment. This closed-end fund distributes enormous amounts of cash to shareholders, financed partly through investment earnings and partly through returns of capital. Yield-hungry investors have become so enamored with those distributions that the fund's market price has at times risen to a substantial premium over its net asset value. The fund's managers have exploited that premium effectively. Periodically, they issue new shares at elevated market prices. Because the shares are sold above the value of the underlying assets, the transactions can increase net asset value and benefit existing shareholders. The resulting performance record can therefore appear impressive, but the strategy has an unmistakable element of circularity. Its continued success depends, at least in part, on a steady stream of new investors willing to purchase shares at a premium. That does not necessarily make the fund fraudulent or incompetent. It does, however, make the economics more fragile than the headline yield suggests. Recommended alternative: avoid financial performance enhancers. Buy a diversified, low-cost index fund and let genuine investment returns do the work. The bottom line: the fundamental principle is simple. A distribution is not automatically income. A fund can pay investors 10%, 15%, 25%, or even more in a given year. That does not mean the underlying portfolio has generated an equivalent amount of sustainable economic return. The cash can come from several places: interest and dividends, option premiums, realized capital gains, leverage, the sale of portfolio assets, or the investor's own capital. Only some of those sources can support a distribution indefinitely without impairing the investment's long-term value. Before chasing an extraordinary yield, ask a more important question: where is the money actually coming from? If the answer is complicated, obscured by financial engineering, or dependent on the continued sale of options and other assets, the headline yield may be less valuable than it appears. In investing, the goal is not to receive the largest check today. It is to receive a stream of cash that the portfolio can genuinely sustain tomorrow.